I think silver is about to go into the $60, $70 range. I think it'll do it this year. That's not the end of it. That's the acceleration phase I think we're entering. I think gold will advance strongly during that time, but it will be outpaced by silver dramatically. Same with the miners. Where's gold ultimately going? Let's give you some context. I suspect a lot of these kind of things will happen. I'm not advocating or predicting. I'm just saying this is different this time. So don't expect gold to go up to a certain level and have a major bear market. This time, I think you might go up to a certain level, wherever that may be, and it's not anywhere near here, and it's institutionalized. So it's a different reality we're dealing with, I think. Get some data points and one more governor to shift. Even Powell may have to sit down in his chair and let the other guys take control. I don't know. They're laggards, and they're really not a driving force. They're driving force in the sense that they ongoingly decay the money unit in terms of its real buying power. Every decade, you almost double the money supply. And lately, we've been really accelerating the money growth, them too. And they create interest rates, or the cost of money. It's like, what's the price of corn? It's fixed by the government. Well, no, it's not. But the price of money, which is an essential transactional commodity, its price is fixed by the government. So it's like a socialist money unit. Well, but then it decays constantly. We put out a chart in a recent report for fun, the Venezuelan stock market. Boy, we put it on the front page and blew it up. It's so lovely. It's just exploding. We should all invest in Venezuela. The problem is the money, you can't buy a loaf of bread with the thing. It's exploding in price, but it doesn't mean anything. So there's some stock indexes down there, and they look great. I mean, we said we should be in the Brazilian stock market. So when the S&P makes a new price high, think about it. Is it really making a new real value high, or is it some nominal? If you took the dollar value out of it, you'd see a different chart. In other words, well, when your granddad built a house, it cost the average price was $4,000. Now the median home price is $442,000. What's happened in a couple generations? I guess homes are just better, aren't they? Oh, the money's degraded. A loaf of bread when I was a kid was under 20 cents. Okay, we have a wheat drought. No, well, we don't. Okay, you get the point. The same is true with the stock market, and people don't think about that. Anyway, gold does. That's the ultimate driver of the monetary metals, is the ongoing decay in the fiat stuff. I don't know where it's going, except to say it's no longer going to lead. Our technical assessment is that silver and the gold and silver miners will now move from the back to the front in terms of performance. They have lagged gold on an upside basis, on a percentage gain basis. They've gone up nicely over the last several years, but not as much as gold. So they've underperformed, so to speak. They're technically at the point now of breaking out of that trend of relative underperformance. So when you don't focus on the price of silver, which looks quite good, or the miners, they're quite stout now, but the relative performance to gold, and technically it is breaking out, favoring them. So whenever that happens, it almost always converts into a net price acceleration in all the monetary metals, silver, gold, and the miners, meaning they go up in an arm wrestling manner, and then suddenly when they accelerate versus gold, outperform it, that's usually when price also starts to go berserk. And I think we're there. I think silver's crossed that line. I think it did it early this month, getting up to the high 34s again. There were two highs at 35. Price guys noticed that. We took that out. That's not really that important, but there were some momentum factors that came into play in the upper 34s that said, you're out of here. Okay. And since then, we've surged to 37. And right now we're trading, in a range mostly in the weekly closes for the last 4 weeks, mostly above 36, just going to sleep up there, quite firm. I think silver is about to go into the $60, $70 range. I think it'll do it this year. That's not the end of it. That's the acceleration phase I think we're entering. I think gold will advance strongly during that time, but it will be outpaced by silver dramatically. Same with the miners. Where's gold ultimately going? Let's give you some context. I don't know where a technical target is, because the reality we've been talking about is so serious that when it unfolds, it's 52 card pickup in terms of where things might go. But if you go back and look over 50 years of gold's history, you've had a couple bull markets that were both eightfold moves, from bear low to bull high, bear low to bull high, eightfold, 8 times. Our low was 1,050. And annual momentum turned up shortly after that by our metrics at 1,140, and we've not changed our views since then. But if you go eightfold, you go to $8,000, and that's merely replicating the dimensions of 2 prior bull markets that existed under far less dangerous dynamic potentials that we are currently in. So 8,000 would merely be doing it again. So you could say, well, 8,000 is a target, but it's really not. It's just a norm. But in that period, I think it's the mama market, but watch silver and the miners. They're the better place to be. And I think the old highs at 50 were phantom anyway. If you look at them closely, they lasted like hours or a few days. They really weren't like living up at 50 for a long time. And they were so long ago that if you factor in the continued degradation in the money unit that you're measuring by, we probably have to be $200 just to match those $50 highs in real terms. And don't be surprised by that number either. But no, I think that the technical acceleration is something we could define technically. There will be news stories, no doubt, that come into play. But there will be like ambush news stories that come in after the fact. So if you're not already in and you're waiting for a reason, the reasons will come, but you'll have already missed the move. Even a doubling. But many markets do that. You go back and look, there's a lot of base metals over the last few years have gone berserk on the upside, and they fail. But this is a monetary metal too. And a lot of investors fail to remember that. That's why they dumped into silver in early April. We had the drop from 35 to 27.5 in a week or so, most of it in 2.5 days. Gold only flinched a little bit. They dumped on silver thinking, oh, it's part of the economy. No, it is a monetary metal. It is linked to gold. And if you look at long-term history of the price of silver, it doesn't correlate well to the Bloomberg Commodity Index. It correlates well to gold. And it's been lagging gold on a percent basis, but it's been trending with gold. And I think it's just about to go into one of those phases where you can go back and see examples of this in the past, 79, 80, 2010, 2011, where silver just went rampant. It left the earth. And it wasn't due to factors that we've got anything like now. So it's different this time. And I'm not predicting that's the end of the bull. I'm just saying this is the next surge. And beyond that, God, I don't know where we're going. A couple $100 an ounce wouldn't surprise me. It depends on these other realities that are about to unfold in a dark direction. It's a lagged indicator. In other words, if you go back to 2000 or 2007 and look for unemployment as a signal to sell, no, stock market told you first. In other words, if this new high in the S&P is what we argue it is, a trap, and suddenly you begin to unwind back down again. And I'll give you a number. You don't want to see 5,700 again. Okay, now we got to 4,800. I'm saying we're now, above 6. You don't want to see 5,700 next quarter. Okay? That would be a solid sign that the whole high was a fake out. And by the way, if you're a price guy, and the data points will follow the market. That's what the point I'm making. So the data points that Powell likes to look at, they're going to smack him in the face. And he's going to look kind of stupid because they do lag the market. They never lead. Now, he's going to have another problem if just one more Fed governor crosses the line. Because he had one that said, no, we need to cut now. And then suddenly there's 2, need to cut now. You get a third one, it starts to become a chorus. And then suddenly he looks reluctant for what reason? Are these 3 people stupid? Or is he doing it for another reason? Anyway, he's got a political problem if he loses like one more Fed governor. And the data points will follow and vindicate cutting rates. They'll get what they need. But then there's the other factor I said, that T-bond market, watch it. And watch the dollar, because those aren't on the mandate list. But they will have an impact on things that do affect the data points. And that's when suddenly heads will turn quickly and late. No, I don't care. I frankly have said that this particular market economic event that's about to happen, and I think a lot of it's going to occur between now and the year end in terms of price drama in certain markets. Dollar index, for example, perhaps a panic in the T-bond market that causes the central bank to wet themselves. Stock market suddenly, the new high didn't hold. What's going on here? Things like that. Commercial real estate. Company did what? These type of events aren't like we were in the late 70s or the gold bull move that went to 2000, in 2011 and 1900. The stock market drop in 2008 and 9. This is different. I think this is going to be far more serious. I think the wave effects will hit reality, people in the street, so to speak, their day-to-day lives, whether they hold stocks or not hold stocks in their retirement accounts. And of course, if they do hold stocks in their retirement account, they might soon have nothing to smile about if I'm right about the trend direction of the stock market. That's the only thing they can smile about right now. Not their credit card debt, not their student loans, not their late mortgage payments, but my stock market portfolio is back near its high or whatever. This time around, you could have some major fundamental changes in reality in the sense that certain institutions go by the way. Certain notions of what's right and wrong in terms of policy go by the way. And I would think, I'll make a bet, when this gets more past the crisis point, there won't be a central bank. That there'll be enough countries elsewhere that revert to a non-fiat currency, meaning a gold-backed or silver-backed currency, where even in the U.S., which we're now lagged that reality, we'll suddenly realize there'll be enough realization that, hey, this boom-bust cycle process that we've been in for 100 years, caused by monetary booms and busts, which lead to stock market booms and busts, hasn't been working. They're always too late, or they always cause something. How about we just have a currency that's real? You can't inflate it overnight because you want to.
When momentum shifts, markets don't just move, they break. Michael Oliver just gave you a glimpse into what's really coming. Not just trends, but major tremors in the financial system. If you're serious about staying ahead of the curve, smash that like button, subscribe, and hit the bell icon, because the next wave isn't a correction, it's a reset.